Hello folks, Charlie Gibble here with the video of the week. This video I'm really excited about. This video I have my extra large cup of coffee for. For this video I actually thought of putting something different than coffee in it, but I have to be sharp for this one. Why? Because this is some particularly meaty content that I'm going to talk about today. Now, a couple things that I do not do in these videos and will not do in this video, particularly will not do in this video, is two different things. First and foremost is I have opinions on all of this stuff. I do not share my opinions on whether this particular strategy is good, this particular strategy is bad, whether I think interest rates are going to skyrocket, whether I think they're going to plummet. I don't share my opinion a lot. Effectively, I report, I let you decide. Why do I do that? Well, I do that because I save my opinions, as well as the second thing, sales ideas. I save those for my customers, for those where I speak at their events, whether I'm consulting with them, whatever. I do not do those and will not do those in these videos that I do, and you could probably see that by my previous videos. But this content today is particularly meaty. Yes, I do have opinions on them, but I'm going to report and let you decide. Now, as I get started here, I want to set the framework by just showing you four different diagrams. These diagrams are to set the stage for the more meaty content on the volatility controlled strategies. I don't know if this is going to be 2 videos, 3 videos, 4 videos. I'm not scripted here. I just do a little research to prime my pump, so to speak, and then I get going on video in a somewhat casual format. You guys and gals get inundated with the formalities a lot. I found that these videos work best if it's just me talking. What comes off the top of my head comes out of my mouth, outside of opinions and sales ideas. So again, because these videos are limited to 10 minutes, there may be 2 videos, 3, 4 videos, I don't know yet. So let's set the framework for volatility controlled strategies, which have really proliferated. I have a list of volatility controlled strategies here. They've really proliferated around 2014, 2015. So yeah, over the last 4 or 5 years or so, I'm looking at a list of about 75 indexes, not strategies. These indexes, about 75% of them were created in 2014 or later. Now, just a point of clarification here, there's a difference between a volatility controlled index and a volatility controlled strategy. Although I may refer to them synonymously, technically they are not. The volatility controlled strategy, the term strategy is something that we use a lot in the index annuity world, right? A strategy is a strategy that's linked to an external index. So when I talk about strategy, that's more at the product level. The index itself was something that some investment bank somewhere along the line created, whether for the sole purpose of marketing that index to an insurance company so that insurance company can use it in their index annuity, or for the purposes of whatever, investors, institutional, the S&P 500 for instance, right? That was created in, was in 1955 or so when the S&P 500 was created. Index annuities weren't around until 1995. However, some of these indices were created for the sole purpose of the insurance companies that had this wonderful idea, had these great ideas about, volatility, I guess that's an opinion, right? Whatever. Had these ideas about volatility controlled strategies and some sort of an index that can be created, so thus that investment bank, BNP Paribas, Goldman Sachs, Morgan Stanley, Merrill Lynch, et cetera, that investment bank may have created that for the purposes of the index annuity. But just know that those two things are different. But these strategies or these indices, as I can see here by my sheet, have really proliferated since 2014 on. Why is that happened? 4 different diagrams I want to show you here, again, to set the framework. By the way, if you do not know how call options work, or if you do not know how insurance companies do this, it would certainly behoove you to look at the 2 previous videos that I did that are in my LinkedIn profile as well as on YouTube. That'll clarify it a lot. But for purposes of this, I just want to kind of rehash real briefly those 2 different concepts as well as a couple other concepts here, again, to set the framework for volatility controlled strategies and index annuities. So once upon a time, this was the case. Once upon a time, and then it'll come up to present day. Once upon a time, a client would give an insurance company $100,000. And that insurance company would do what with that $100,000? Well, they may take, say, $95,000. As I mentioned in my previous video, greatly simplified, right? $95,000 and dump that into their general account where once upon a time, that general account, those bonds that that insurance company purchased may have yielded that insurance company, say, 6%, right? That's once upon a time. Well, then what did that insurance company do with the other $5,000? Again, that insurance company did not invest that $5,000 into the stock market. These are not securities, right? These are general account assets. But that $5,000, where did that go towards? That's where that insurance company would go to the investment bank. And because this was once upon a time, it was usually just the S&P 500, right? They said, investment bank XYZ. Here's what I want. I want all of the upside in the S&P 500 you can give me. I'm going to give you $5,000. The investment bank said, well, let's see, for a call option on the S&P 500, you have $5,000. I can't give you all of the upside, but what I can do is give you everything the market does up to 10%. Once upon a time, right? So the insurance company would say, yeah, no problem. Here's the $5,000 we're going to give you. And if the market goes up 10% or more, we'll pass that through to the client. And by the way, we will call that 10% a cap to the consumer, right? Investment bank says, no problem. The insurance company pays her $5,000 for the call option. Effectively, technically, call options are bought and sold, but this is simplified so everybody can understand this, right? But each year that call option is going to expire worthwhile or worthless, assuming this is an annual reset design. Each year it's going to expire worthwhile or worthless, right? Well, then how does the insurance company fund that upside potential year after year after year? How the insurance company funds that upside potential is really this income that's coming in from the other side of the $100,000 investment equation, right? Each year, this $6,000, roughly $6,000, it's coming into the insurance company. The insurance company may shave, say, 1% off the top. That's how the insurance company makes their money with annuities, right? One of the ways is 1% off the top. That's called a spread to the insurance company. But that insurance company may take that 5% year after year after year, assuming that 6% stays at 6%, which we all know it didn't, right? That 5%, and buy call options year 2, buy call options year 3, buy call options year 4, right? That is no longer the case. Today, the case may be closer to 3 or 4% new money rates, right? Closer to 4% than 3%. The 10-year treasury today is at 3.04%. But companies, insurance companies, don't invest a huge chunk of their money in insurance companies. It's actually mostly corporate bonds. But whatever, let's call it 3%. That's where the 10-year treasury is today. Today, that 6% is actually 3%, let's say. So 3%, that means that the insurance company may shave 1% off the top. Well, what's our remaining call option budget? What's our remaining call option budget? It's only, say, 2% or $2,000 that can go to the other side to go to that investment bank and say, hey, I have $2,000 here. What kind of a call option will you give me? Are they going to give you a 10% cap? Heck no, they're not. They're going to give you a 4% cap or a 5% cap, right? And why is this? Why did this change? Why did this change and why did this dynamic take place? Because of this. In 1981, the 10-year treasury was at 15.84%. Went up a little bit there. 1994 spiked 3%, but continued to go down. I always bring this up, by the way. 1984, the Great Bond Market Massacre. You Google Great Bond Market Massacre, the 10-year treasury went up 3% from late 93 to 1994. 1995, after an insurance company realized, the industry realized, wow, the bond market had the Great Bond Market Massacre. The S&P 500 finished down in 1994. Certificates of deposit actually plummeted. Where is one to go where their money is safe and they can get somewhat of a reasonable return? What was born in 1995? Index annuities. We are in an environment today, which is the very reason that those products were created in the first place, right? But I digress. 15.84% to 3.04%. As a result of that, the call option budgets have made it such that insurance companies are now only able to give consumers, say, 4% caps or 5% caps. Well, how do these uncapped strategies work? And by the way, not all volatility controlled strategies are uncapped. Then how are they able to give a consumer uncapped upside potential? Let me explain that here. In my video on call options, I talked about a strike price, right? And in my video on call options, I said, okay, so here's a security. Let's say it's the S&P 500 at 1,000. Just round down to 1,000 to make it simple. There's a strike price. Although technically with index products, that strike price is at the money, at wherever it started that year, right? Just bear with me here. The strike price is usually what the person on the buying side, the insurance company, for instance, can buy that security at, the S&P 500, for instance, over a year's period of time. So the market goes up to where it's much higher than the strike price. That's a pretty darn good deal for the entity that bought that call option, right? Now, again, this is loosely related to index products because technically index products, the strike price is here. But regardless, on the other end of that trade is the investment bank. The insurance company is going to the investment bank. That investment bank is called a counterparty. The counterparty has risk, right? So the insurance company buys that call option for $2,000, and what that $2,000 buys is dependent upon how that counterparty views their risk is. How extensive is the risk to them, because they're the ones that are going to say, well, your cap is going to be 4%, it's going to be 5%, et cetera, et cetera. So the fact that we have less money than we used to is what brought caps down. Also, let me ask you this question to get to the volatility part of the volatility controlled conversation. For that investment bank, let's take this hypothetical S&P 500. Actually, it's not real hypothetical. Let's say that the S&P 500 over time has gone up and down, up and down, up and down. When that investment bank sells the insurance company the call option, keep in mind it's the investment bank that has to pay off what it is that market goes up above the strike price. In this scenario, is the investment bank on the hook relative to this scenario? Let's say the market was always just like that. Didn't go up 1%, didn't go down 1%. Every single year, it was just effectively zero. It was like cash, right? No volatility there. The investment bank is more on the hook with which of these two different strategies? This strategy, right? This is why volatility, you know, the benchmark volatility gauge, at least for the S&P 500, is called the VIX index, VIX. This is why the higher the volatility goes, the more expensive call options are. Well, what if these investment banks can create an index that's not this severe? No, it's not cash. Obviously, that would be somewhat degrading to these index annuities that offer this, right? But somewhere between here and there, wouldn't that cheapen the price of these call options or increase the caps on these call options that we're purchasing from those investment banks, or maybe completely do away with the caps? Absolutely, because in this example, very extreme example, is that investment bank on the hook if they say, yeah, give me your $2,000 and we'll give you no cap, no cap. Technically, the investment bank doesn't talk in that type of language, but you know, the cap is generated by the insurance company, but the math comes from the investment bank. No, there's no risk to the investment bank should volatility effectively be zero, right? No volatility equals very cheap call option costs for that reason. Now to talk about vernacular here. With the uncapped strategies or volatility controlled strategies, you see a lot of 5% volatility trigger or 8% volatility trigger. Right now they're 5% to 10%. Maybe there are some outliers, but most of them are 5 to 10%. What does that 5% represent? What does a 10% represent? Let's simplify this. Over time, since 1928, I want to say, the S&P 500 went up 11.4% per year on average. Not the compound average growth rate, the mean over that period of time. This is the most technical I'm going to get here, but this is important. 11.4%. Did the S&P 500 go up this way, however? The answer to that question is heck no, it didn't. It went up this way, right? Although it averaged, the mean return was 11.4%. That's more like how the S&P 500 went up over that, 90-year period of time or so. Okay, so what measures this? That's volatility, right? What measures volatility? Some of the securities folks may be saying, well, that's called standard deviation. The answer to that question, or I guess it wasn't a question, that is absolutely correct, standard deviation. And what is a standard deviation? Well, the S&P 500's standard deviation over that period of time was almost 20%. A little more than 19%. I want to say 19.5%. Okay, what does that mean? So the 19.5% S&P 500, some of these volatility controlled strategies, 5%, 8%, right? What does that mean? What a standard deviation is basically the deviation, the average deviation from the mean. So let's say that went down 40%, that went up 20%, that went down 20%. Effectively, what a standard deviation is what is the average of all of the deviations over that period of time, right? In short, it is a calculation of volatility. So when you see these volatility controlled strategies, that's what that volatility trigger is. And by the way, if we can get that standard deviation down to say 5%, 6%, 8%, is that going versus 20%, right? Is that going to cheapen the call option that we are purchasing from that investment bank? By the way, many times it is also that investment bank that created the index who's also selling you a hedge against that index. Yes, it's going to cheapen it, which means $2,000, you may get an uncapped strategy. You may get no cap on it that investment bank is passing through. This is the first video. I'm going to dig a little more into the actual strategies. I'm not going to name strategies, but in the second video or third video here, I'm going to talk just about what to be aware of, as well as really the value of these things. I do have opinions on everything, but I'm just reporting and you can listen. So stay tuned for the second video here.